In this video, I'm going to show you one simple strategy that I use to help me ride the wave of a stock going up so that I can maximize my profits. Welcome to Expanding Wallet, home for empowerment. We inspire greatness and help you learn skills for creating generational wealth. My name is Andrew Clarke, and I'm the founder of Expanding Wallet. So today, I'm going to show you the strategy that I use to increase my profits in stocks. And then I'm going to show you an example using that strategy. And the last thing we'll talk about is the pros and the cons of this strategy. So my background, I invest in both real estate and stocks. And when it comes to stocks, I'm primarily a long-term growth investor, meaning that I research and find companies that I believe will have massive growth potential in the future. And so I buy into these companies and I hold on to them usually for 1 or more years. So before we dive into the strategy for maximizing profits with stocks, remember to smash the like button and also subscribe to this channel because I will be releasing a video on what I look for to find amazing stocks. And that's not a video you want to miss. The strategy that I'm going to talk to you about involves using what's called a selling trailing stop order. And I'm going to read the definition off to you, and I put some of the words in red that really matter the most. But don't worry if not everything makes sense. By the end of this video and with the examples, you should have a very solid understanding of what a selling trailing stop order is. But here's the definition from Investopedia.com, which is a selling trailing stop is designed to protect gains by enabling a trade to remain open and continue to profit as long as the price is moving in the investor's favor. The order closes the trade if the price changes direction by a specific percentage or dollar amount. Again, protects gains is important, and then continues to profit, right? Key, because we're talking about maximizing our investment here, as long as it continues to move in the investor's favor. And then there is a specified percentage amount where the trade will be closed. So again, those things you'll really understand well by the end of this. So let's just dive in here. Let me set this example up for you. So just imagine here for a second that we've bought a stock, or you've bought a stock that is at $5 when you bought it. And now you were planning to sell it at $9. Well, you look and it's at $10, okay? And so you could just sell it and take the $10 profit, or you could wait and see what happens. Now, you can actually use this method with the selling trailing stop order to allow you to actually be able to set certain criteria that will actually automate this trade for you. So that will allow you to not sit there and have to watch it. And that's what I prefer to do. I do not like to sit there and watch stocks. So what happens? So, okay, stock price is at $10. So let's say now you're going to set up your trailing stop order. So the first thing you have to do is you have to set this trailing amount. So remember, it had said that in the definition, you can set this amount based on a price, a dollar amount, or a percentage. And so what this means, this trailing amount, and you'll understand it a little bit better when we go to this slide, but what it means is that the initial amount is this $9. So you just take the current stock price when you set this trailing stop order, the $10, minus your trailing amount, the $1, and that gives your initial stop price, which is $9. Your initial stop price, that says, hey, if it hits this price, then sell the order, okay? And why it's an initial stop price is because that $1 trailing amount, it moves as the price moves up, because remember, it changes for the investor's favor. And so what that means is if the price goes up to, like, let's say something big like $20, okay? Now you've got way more profit, right? Glad you didn't sell at $9. You've got way more profit, and then that trailing amount, it's now changed your stop price. Your stop price will be $19. So if it goes up to 20 and comes back to 19, your order will automatically sell, meaning that your shares will be sold and now you'll capture your profit. You don't make profit until you sell, right? So there's one last thing when you make your order, and that is your order expiration. So what that means is this order is only going to be open for a certain time frame. And usually I'll put in 90 days, but again, this can vary based on what your strategy is. And so what that means is, if let's say it never hits your stop price, then the order will never execute, meaning your shares will never be sold. And if it doesn't, and it only has this set time frame to do that, which is 90 days in this case. So that's just how that works. So just keep that in mind. Now I want to just run through some examples. Keep in mind, kind of the setup, the scenario here, which is, again, my strategy, usually growth strategy. So assuming you bought these shares at $5, what would happen if that share price drops to 9, right? This is kind of the simple case, right? So what happens to the stop price? Does it change or does it not change? And then what happens with your shares? Are they sold or are they not sold? Answer: the stop price is unchanged. It stays at $9 because the stock price didn't go up. It actually went down. And so therefore, since it went down and it hit your stop price of $9, your shares are sold. Okay, so you're no longer in that position anymore. That's what that means. Now, let's go the other direction. What happens if the share price goes up to $12.50? Remember, your trailing amount is $1. So what's your stop price? And do the shares get sold or not sold? Answer: your stop price changes to $11.50 because you just take the current stock price, $12.50, because it went up, minus your trailing amount, $1, and that's how you get the $11.50. Key thing here is that your stock is not sold and your stop price has now changed to be more in your favor, and this is where you might lock in some gains, or this is where you might be increasing your profits now. Now I'm going to give you one more real life example that actually was an opportunity I missed out on. And before I show you that, I just want to say, when it comes to knowledge of investing, to me there's 3 layers, okay, of knowledge. The first is understanding terminology. Obviously words matter, and the language of anything you do matters. So terminology is kind of the first and easiest layer. Then you get to the strategy layer. Now you need to understand the different strategies and find one that works for you. And the third layer, and probably the longest one to develop and learn, is really instinct. And so why I say that it's the hardest one, or not the hardest, but just takes the longest, is because you have to have been in something long enough to kind of see patterns and develop those patterns in your mind, to where instinctively you just kind of know what's going to happen with a high level of confidence. Maybe you don't know, but with a high level of confidence, you do know. And so this third layer, this instinct, this is actually the example I'm going to show, because it's not necessarily, it doesn't fall into my growth strategy, but instinctively, it's just something that I would just know to do and act on. Here's the real life example where a few weeks ago, I happened to be on the phone, so I missed this news notification on my phone. I was talking to a contractor about a project I'm working on, and within the 20 to 30 minutes I was on the phone, I get off and I see the news notification that I missed. And this is the notification: Amazon strikes a deal with a firm, the buy now, pay later provider. Okay, so what does that mean? It means that Amazon is going to work with this company, a firm, to allow their Amazon customers to pay for things later, right? So what does that mean to me as an investor when I see something like that? And why did I say this is, kind of an instinct thing? Let me break it down simply, that when you see a massive company like Amazon partnering with a much smaller company, and I really have never heard of a firm, but I'm sure they're probably a popular company, but much smaller than Amazon, that can be a very big deal profit-wise for the smaller company. And so how do you think then investors are going to react? They're probably going to buy the smaller company's shares. And so instinctively, I know that's a signal, hey, go buy this stock really quickly. So if I hadn't been on the phone, seen this notification, within minutes, I would be buying those shares. And so let me show you exactly what happened with the shares in a firm. So check this out. A firm is at $67.90. And now that article comes out, and look at what happened within minutes. This is actually a 5-minute chart. So within 5 minutes, it's at what looks to be $80. But within minutes, this thing shoots up, okay? So again, what I would have done was see the news notification, buy the shares, put in my sell trailing order, okay? And I probably would have put in I usually put in 5%, 10%. I usually put in percentages, okay? I don't usually put in dollar amounts, but that's just a preference of mine, but you can do either one. But let's just say I had done that, okay? And let's say I put in, about 5% here of a trailing stop. This thing peaks at a little over $98, okay? $98.21. All right, and then you can see that it comes back down. And again, this is actually the next trading day, which is a Monday. But what you really want to know is just that because that sell trailing stop is in there, I can walk away from this thing, okay? And I would have probably sold out. I know later it went down to about 90. So let's just say, a few minutes. So I get in at like $75, sells at 90. That's a 20% profit. And for me, this would have taken me under, let's just say about 3 minutes. This would have taken me about 3 minutes to do. So in 3 minutes of a little bit of my time, right, 20%. And that's why I wanted to just kind of share some of this information with you because, sometimes this little news, just getting that and having been in the market for so long, that instinct is developed and you can catch some of these. Unfortunately, I have me on the phone, so I missed out. But Affirm is definitely a stock that is on my list now to watch and to research and understand better because if the market dips, this may be a great opportunity to buy a stock like Affirm, which could potentially have great long-term growth because of their partnership with Amazon. So let's dive into the pros and the cons of using a sell trailing stop order. So the first pro is that you're going to lock in some profit, right? And potentially gain more. So with my long-term growth strategy, I'm usually already invested in these stocks for so long so that by the time I put in a sell trailing stop order, I've locked in massive profit so I can afford if I were to lose 5 or 10%, assuming it went straight down after I put in my sell trailing stop order. And then the next pro is that it avoids me from having to sit there and watch the stock market. Right? It avoids me from having to actually actively go in and then hit the buttons to sell things. So this allows me to do other more important things maybe, or this allows me to work on other things. Now, here's the cons, okay? You might never sell this stock if it never goes to the stop price before the order expires, right? So these orders do have expirations on them. So that's a potential consequence. And if that's the case, you just go back in, you create another sell trailing stop order. Now, the worst case scenario is this. The worst case scenario is that you lose money or make much less profit than you expected due to a large price drop outside of market hours. So there are certain hours between 9:30 and 4 p.m. Eastern that are regular trading hours for the stock market. And then you have what's called after hours, market hours. And so I am able to actually buy into stocks during after market hours. However, sell trailing stop orders only work during market hours. So what that means is in that Affirm example, I could have bought those shares, set up my sell trailing stop order, and then on Monday when it opens up, it had jumped up so much, then my sell trailing stop order kicks in and I make some profit. But what if that had gone the other way? What if things didn't go the way I expected and it went down? That could also have happened. And therefore, you could potentially lose money. Now, that scenario that I showed you, probably unlikely, given that not everyone has access to after hours. But, and therefore, when it opened up, it still went up a little bit more. And so that's part of why I wouldn't expect that to happen in that scenario. And then in my case, again, I'm long-term growth investor, so I'm usually getting in at a great price anyways. So when I'm going to sell, I've already have so much built up profit in there that it's really unlikely for me to take a loss. using this strategy. So again, something to keep in mind though if you're starting out and you're brand new. I wanted to make sure you got both sides in the full picture. If you've never invested into the stock market, or if you're new to investing in the stock market, make sure that you join my waitlist for my ebook on investing in stocks. I'll add that link in the description below. And lastly, remember to learn all that you can, believe in yourself, and take actions that allow you to grow.